3 of my investing journey. Today I'll be going over sort of building off my last video, but more going into tips and strategies and some mistakes to avoid. Now, to discuss the issues that I went to avoid the issues that I went through, I'm going to talk about picking the right investment app. When you pick the right investment app, there's a variety of apps and websites you can use across the internet. But some things to look at are fee structure, ease of use, research tools, account minimums, regulations and trusts, and what you can trade. Now for me, the major issues I ran into are regulation and trust, as the country wasn't as one of the applications I was planning on using wasn't available in my country, and also ease of use, as I was really focusing on something that was easy, and something that was more simple that I would be able to use from. Additionally, it's important to look at fees because some apps charge higher trading fees, where some cost lower ones, as well as account minimums, because it's important because some trading accounts may require you to deposit a minimum amount of money, whereas the ones that I chose actually didn't have a minimum deposit. Now, looking into some things of how to choose what to invest in. There's four main assets in which most traders invest in. There's stocks, ETFs, commodities, and there's crypto. In stocks, these are fractions of a single company, and examples are Google, Apple, Microsoft. These assets have higher potential however, there is also higher risk. This is due to you putting all of your trust and all of your faith in just a single company, whereas things such as ETFs, which are just index funds such as VOO, QQQ, and VTI, these are funds that hold many assets at once. These funds they track sort of a variety of stocks. For example, the S&P 500 tracks the 500 top countries within the US. These assets are good for diversification of your portfolios as they allow for it to be less risky. However, this does come at a cost, as you won't gain as much. But this comes at the benefit of it's less risky. Now, to commodities, these are things more like tangible objects such as gold, oil, and silver. However, you can invest these things through ETFs within the market. And then to crypto, these are things like Bitcoin, Ethereum, and Solana. These are digital assets that, unlike the other ones, they trade 24/7. Crypto is extremely volatile and very speculative. These can incur very high gains, but also significant losses. This might be the riskiest out of the four, and this is more likely tailored to short-term trading as opposed to long-term growth, which would be more tailored to ETFs and maybe stocks and commodities. Now, it's important to discuss risk tolerance, as there's three main levels of risk tolerance: low risk, medium risk, and high risk. Low risk is sort of what I'm looking at right now and is what most people engage in. It's for those who are more cautious. Typically, these people would invest in index funds, ETFs, and bonds, as they're still able to gain money, but it comes at a lot less risk. Now, medium risk, this is for people who are more balanced. This is sort of what I have right now, is I have a mix of some ETF and some individual stock. This is exactly like what the typical assets of a holder with medium risk would be, which is a mix of ETFs and stocks. Now, for a high-risk individual, this is someone who's more aggressive, who is more willing to incur losses and to take more risks at the possibility of a higher reward. These individuals would invest in a lot more things, such as individual stocks, commodities, and do growth plays such as like short-term trading. It's important when investing to sort of decide your risk tolerance, because that helps you decide what stocks and what assets you want to invest in the future. Now, with risk tolerance, there comes differences in strategies, and they're different depending on what type of risk tolerance and how risky your portfolio is. For example, if you have a more risky portfolio, You would hold for shorter times. You would be tracking the market very constantly to make sure there's no sudden fluctuations within price and yeah, etc. However, if you have more low risk, it would be more examples such as an example like dollar cost averaging, where you, regardless of the price of the current price of the market, you invest a fixed amount every single time. With more low risk, you would end up not really watching your stocks that often, or you would not really end up sort of selling your stocks that often. You would just invest and hold it for a while. Now, some common mistakes when choosing stocks are chasing the hype, no research, panic selling, trying to time the market, having no diversification, and ignoring fees. Now, the biggest ones I would say are panic selling, trying to time the market, and chasing hype, which sort of somewhat goes in no research. Panic selling and timing the market are very similar, and and they happen with everyone, especially beginner investors. Trying to time the market is, if you're inexperienced, it's very risky and often doesn't end up well. And this sort of relates to panic selling, where if you suddenly have a dip, you might just think like, oh no, like my stock is down a lot, I have to sell right now, I can't get any more losses. This often can not end up well, because if the stock happens to go up all of a sudden, then you just missed out on a lot of potential returns. Another big mistake is chasing the hype and not researching a stock. If you just blindly follow what other people invest in and not actually research your stock and have sort of a good reasoning and actual like decisions behind your investment choices, then it can end up to sort of just not good investing, because you're investing in everything you're investing in things that everyone else is talking about, and that can sometimes not be well, because if there's a stock that's overhyped, you may end up investing in it with hopes for big returns, but then end up just being disappointed. So it's important to avoid these mistakes when you're choosing the stocks to invest in. And that's a wrap on video 3. Make sure to be staying tuned for my next video, in which I'm going to talk about what I learned from my first couple months of investing.